Good evening, TheoTrade. This is Corey Rosenblumen. We're watching the Theo Nightly Video for the 8th of April here in 2021. And something odd's going on behind the scenes. What is it? It's not that the market's at all-time highs. The market is at all-time highs. At least the S&P is at all-time highs. It's what's going on behind the scenes. So what we're looking at right now is a comparison. We'll take a look at them chart by chart. This is the S&P 500 by the S&P Futures, ES. It's making a series of higher highs, higher lows. This is an hourly chart. They're all in the same time frame. This goes back a couple of weeks. Underneath that is crude oil. Now, generally speaking, not always, the economic tendencies that tie oil and crude together mean that they have a positive correlation, meaning when one of them goes up, the other one goes up. When one of them goes down, the other one goes down. So that's a positive correlation. And again, these are positive doesn't mean they move in up. It means they move together, same direction. So if they move down, they both move down. That's still a positive correlation. Now here's what's odd. The equity market recently has moved to all-time highs, but crude, the oil market, has gone sideways. So those are the two what we call correlated markets. Stocks are very, very strong, but crude oil, which is also economically sensitive, not quite as strong. But here's where I think the attention is. Now, despite the fact that the equity market is here, what are these charts? This is gold. GC is gold futures, and underneath that is ZN or bonds. So this is gold, and then this is bonds. Now these have an inverse relationship. And when the stock market moves to the upside, these tend to move to the downside, particularly the bond market. So again, we'll just go stocks. We'll look at oil, and of course, gold and bonds. Again, these move together. If that rallies, this tends to rally. Here's where the interesting points are coming in, hence our discussion. These move opposite equities. These are moving higher, but so are equities. That's a little mysterious behind the scenes. So we'll pick the video up. We'll continue forward with that in mind. And we'll take a look at these on the bigger picture. So again, this is our S&P 500. I still think we're in this rubber band snapback type of phase where we can take a look back earlier into May and June, early June 2020, where the market was persistently to the upside. In that case, 3,100 was a key level. And instead of pulling back to the downside to 3,000, the market gapped up 3,150, instead traded at 3,200. And if that wasn't the top of the market, which sure enough seems as a good chance to get some put or some short positions on at 3,200, let's target 3,000. The market, I know we jumped ahead, but the market went a little bit above that and then came back down to 3,000. But it took the scenic route before it had the snapback. The other time that happened was similarly, maybe a little bit better, and I have some annotations here just for reference. When the market was rallying into 3,500, that's a good spot to get short, a good spot to get that rubber band snapback. Instead of going straight down 100 points, the market went up 100 points. And those 2 days, these days right here, if you want to go back and study it, it's September 1st and September 2nd. Those were particularly painful for the bears. But if the bears just held on for a couple more sessions, if they did that, they were much rewarded for their discomfort, frustration, and financial paper losses. Of course, it was the bulls that thought they had the game, thought they had everything going for them. They slipped. So getting long at any point in time during this end of August, doesn't matter where the long was purchased, if they held on, 2 days later, all those gains were gone. And that's not dissimilar of how we think about or frame the market right here into April 2021. Are we guaranteeing a snapback? Of course not. Markets are a game of probability, but that's the better outcome, the better option. If you had to be a bull or a bear at all-time highs, even though it looks great right as we have the video, the next phase of the market tends to be that snapback. So here's the strategy. If you're aggressive, you're probably already short. You probably already have purchased your puts and you're hanging on. Probably frustrated, but still hanging on. If you have not put a position on and you're talking about the broad market or you're waiting for the next setup, that next setup, if you want to play aggressively, is the put side. But if you want to wait and sidestep, the next trade setup is going to be a buy the pullback or the snapback once it occurs. This is going to be true in multiple stocks. So let's be defensive if you do not want to short the market. Or the worst thing you could do, I think, at this point is have no position on at this exact moment and then step in with a boatload of calls, a whole lot of calls or long type of purchases. That won't work out in the short term. Maybe 3 months from now, absolutely. But the most likely thing for the market is the pullback, particularly with bonds strengthening off the lows, as is gold. If you are bullish, you do not want to see gold getting strengthened or strengthening. You actually want to see it down at lows. You do not want to see the bond market rally as well. You'd rather see bonds push to new lows if you want to get long. And that brings us to our scan. For swing traders, most of the trade setups you have at this exact same moment would be to the put side, defensive side, or the sell side. That's the strategy for the next few sessions or a couple of weeks. But if you want to play in the direction of the trend, way too late to get long right now for a swing trade. That opportunity is to pick up shares on the next pullback. So I frequently highlight stocks that are making new 52-week highs. This is a simple scan in thinkorswim. It's just the stocks up here. Mine is actually a public scan. It's a public scan, new yearly highs. Different ways to do that. But it's showing stocks that are making new 52-week highs, or technically the highest high of the last 252 trading sessions. Again, there are plenty of ways to find these type of stocks. So what does it mean for us? Microsoft, Google, Facebook, Oracle, Starbucks, Micron, Lam Research. These stocks are strong, getting stronger. So I'll show these just in terms of the daily chart, what we mean and how we use these symbols for trade opportunities. The trade opportunities, this is Microsoft. This is the largest market cap making a new 52-week high. And I'll put this over on a weekly chart to the right to see that that actually, if I am not mistaken, is a new all-time high for Microsoft shares. That goes back to the 2000. We'll push this back. This is how we update our charts and look at time frames. We'll go back. Max available. So correct, that was the tech bubble, and Microsoft shares are well above that. I just wanted to double check that point of reference. Now, that is the weekly chart. The daily chart is all-time highs. Do we get long all-time highs? No, because the next logical move for the market is the pullback, snapback, or sell swing. That was the case here. That was the case here. That was the case here, and on and on. The most recent time was into January and February. Would rather have been a seller from Microsoft short term than a buyer. But we want to join the trend on the big picture. That is done with pullbacks or retracements. And that we need the market to pull back. If your perspective is, I want to get long, can't do it now. Have to wait a few days or maybe a week or two to enter into these type of positions. Google is no different, with its strength on the weekly chart and higher highs achieved on the daily chart. Facebook, not much different, that it's up above this 300 and into about 315 per share. It also has strength on the weekly chart for long-term perspectives. There is Oracle. Again, where are we? Way overextended with a probability for a snapback. And these snapbacks don't tend to be nice and orderly. Sometimes they happen in one trading session. If you're getting long up here in one session, it could be all wiped out. For the short-term swing trader, it is much better to buy on the pullbacks or wait patiently for the market to come back in. And we use these moving averages as points of reference. Starbucks is another, and Lam Research. And the list goes on. So these stocks right here, 36 of them are making new 52-week highs as candidates for future pullbacks. Future pullbacks, not current pullbacks. Be careful, be safe. If you are aggressive, the thing to do is to purchase the puts and try for the fade. If you're not aggressive or a new trader, it might be a good idea to stand aside for just a few moments, days or a week or so, and try to purchase shares on the next pullback. Pullback if. I know it feels like if and when it occurs. And that's going to be true for the S&P, the Nasdaq, shy of the all-time highs, the Dow, and of course the Russell. It's a little bit weaker. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for April 8th, 2021.